In this video, I'll provide a review of Diageo and what I personally look for when evaluating potential dividend stock purchases. In the first section of the video, I'll run through what the company does and how they make money. Then I'll look at some of the numbers and metrics that I find useful in evaluating companies, as well as looking at the dividend history and also the company's revenue, net income and cash flow. And finally, I'll offer my own individual thoughts and opinions on the stock. So, who are Diageo? Diageo are a global leader in alcoholic drinks, with an impressive collection of brands across spirits and beer. They produce an instantly recognisable collection of over 200 brands, old and new, large and small, global and local, that are enjoyed in more than 180 countries around the world. Diageo's vast portfolio includes Scotch whisky, bourbon, vodka, rum, liqueurs, tequila, gin, local spirits, and beers. They own world-leading brands including Bell's Whiskey, Johnnie Walker, J&B Scotch, Ciroc, Tanqueray Gin, Smirnoff, Captain Morgan, Bailey's, Gordon's Gin, and Guinness. Diageo distill, brew, bottle and distribute their spirits and beer brands through a globally coordinated supply operation, and, where possible, they also produce their goods locally. It was the world's largest distiller until being overtaken by China's Kweichow Mutai on the 9th of April 2017. Diageo actually own two of the world's 10 largest international spirits brands by retail sales value, by owning Johnnie Walker Whiskey and Smirnoff Vodka. Let's now take a look through the numbers and metrics that I find useful in evaluating stocks. Diageo has a current dividend yield of 2.07%, and last year's dividend yield averaged at 2.24%. So, at first glance, this isn't going in the direction that we'd like. However, if we remember that dividend yield is just the dividend paid divided by the share price, a huge reduction in the price will have an effect of boosting dividend yield. And over 2020, Diageo's stock price plummeted, and this will have had an effect of boosting the average yield over 2020. Speaking of the dividend, Diageo have increased their dividend consecutively for 23 years. Over the past 5 years, the average dividend per share growth rate was 4.4% per year. During the past 10 years, the average dividend per share growth rate was 6.4% per year. So the growth has slowed down, but this can be expected with mature, established companies. But still, it is nice to see that the dividend is still growing. The payout ratio is currently 62%. This just shows the proportion of earnings a company pays shareholders in dividends, and is expressed as a percentage of the company's total earnings. With payout ratios, obviously the lower the percentage the better, and I tend to consider around 80% as being a high ratio. So for Diageo to have a ratio of 62% is very good. I think this sort of number strikes a good balance between paying dividends and also keeping enough cash back to reinvest into growing the business. Also, if reinvestment opportunities do dry up, the company has room to increase the dividend. And if we have a look at the last 10 years of the payout ratio, we can see that this number is typical of the company. 2020 does stand out, but the company's net income took a hit over 2020 due to the global pandemic forcing many bars and restaurants to shut down, and these would have typically sold large quantities of Diageo's alcoholic beverages. That being said, the average payout ratio over the period shown on the graph is 61%, which again is very pleasing to see for a dividend investor. The market cap of Diageo is £81 billion, and I do like these large blue chip companies in my dividend portfolio, as they tend to be mature, secure organisations, and the dividends tend to be more reliable than smaller cap companies or new startups. Diageo has a share price of £34.84, and this puts it in the top end of the 52-week price range. The 52-week low price of £24.74 happened in October 2020, and the stock has seen a very good recovery since then. The current price is possibly a little high for me when you compare it to the 50-day average of £35.35 and the 200-day average of £33.65. But I would always recommend a long-term dollar cost averaging strategy, which would smooth out any volatility. So now let's look at the dividend history of the company. Diageo first started paying dividends in 1998 and have increased their dividend every year ever since, showing a clear upward trend. From paying 18p a share in 1998, this has now grown to 73p a share in 2021. This is obviously very pleasing as a dividend investor, as it shows me that the company is committed to not only paying dividends each year, but also increasing them too. Businesses that can grow their dividends at a decent rate and maintain a stable payout can generate substantial wealth for shareholders over the long term. Dividends on ordinary shares are normally paid twice a year, an interim dividend in April and a final dividend in October. The approximate split between the two payments is 40-60. Now let's have a look at the chart showing Diageo's revenue, net income and cash flow. It is useful to look at the dividend history, but we also need to look at the company's earning potential and trends, as the revenue and profits of the company will drive future dividend increases. So we can see a nice steady revenue line, which was slowly increasing before COVID struck in 2020. We did see an expected dip because of this, but it looks like making a good recovery since then. It's also worth noting though that these numbers are very large, ranging from around £10 billion at the lowest point to £13 billion at its highest. I like that the net income line follows the revenue line quite closely, which just shows that the management have got the costs under control. The profit margin is currently around 21%, which is also the same as about the average over the last 5 years, which is good to see. A good margin will vary considerably by industry and size of business, but as a general rule of thumb, a 10% net profit margin is considered average, 20% considered good, and 5% considered low. So for Diageo's profit margin to be around 21% is very, very pleasing. Cash flow looks good as well, and follows a similar pattern to the revenue and net income, where we see a gradual steady increase, followed by a COVID-induced dip, and then a steady recovery. So now that we've run the numbers, what is my opinion on Diageo? I believe Diageo has a deep and wide economic moat which should protect it from competitors. When people are at bars, restaurants, or enjoying a drink at home, they tend to have a favourite drink that they turn to more often than not. Whiskey and Coke, vodka lemonade, gin and tonic, and with that they tend to choose their favourite brand. This brand loyalty means that Diageo doesn't have to compete aggressively on price with less well-known brands. For example, if someone enjoys Johnnie Walker whiskey, they'll likely pay a little extra to buy this brand, rather than purchase a cheaper alternative. It's for this reason that brand loyalty also gives Diageo a degree of predictability. As long as the world's population still enjoys an alcoholic beverage, it's hard to imagine a future in which Diageo is not selling these brands around the world in 10, 20 or 30 years from now. The brands that they own, their manufacturing and distribution systems, along with their established relationships with retailers worldwide, provide significant barriers to entry for any potential new competitors. I think it will be very hard and very expensive to build a similar portfolio of alcoholic beverage brands in order to compete with Diageo. But what about the ethical dilemma of investing in these so-called sin stocks? The name sin stocks comes from an association with supposedly immoral or unethical activities. For example, alcohol and tobacco stocks. However, many of us are happy to use these products, so why wouldn't we invest in them too? For me, while I do appreciate that alcohol can impact lives, it can also be enjoyed responsibly, and Diageo do a lot of work to promote positive drinking, which looks at addressing underage drinking, drink driving and binge drinking. By 2030, they're committed to changing the attitudes towards drink driving of 5 million people, educating 10 million people on the dangers of underage drinking, and reach 1 billion people with a message of moderate responsible drinking. They also have a number of eco-friendly targets as they look to become more sustainable in the future. As a very large company becomes even larger, the growth of its already enormous capital base begins to slow. Over time, I would expect to see its earnings growth slow, which ultimately leads to a slower dividend growth rate. But, in my opinion, if you are looking for a consistent, stable dividend payer, then I believe Diageo would take a worthy place in your portfolio. I currently hold 15 shares of Diageo and do plan on purchasing many more in the future. Remember that this isn't investment advice, and you should always do your own research and due diligence before making any investment purchases. I hope that you've enjoyed this stock review and taken some value from it. If you have, then please like the video and subscribe to the channel to make sure that you don't miss any future videos. Also, please let me know what stocks you'd like me to review in the comments section below. Thanks again for watching, and I'll see you in the next video.